to the Smart Property Investment Show with your host, Phil Tarrant.
G'day everyone, welcome to tuning in. Phil Tarrant here, editor of Smart Property Investment. We've got an interesting show today. We like to talk to investors about their story and how they're going about the process of creating wealth through property. I'm joined by Vivian Kelly, my regular co-host. Viv, how are you going?
I'm good, thanks Phil. How are you?
I'm really well. I thought rather than sort of get into some of the semantics about what's going on in the world today, we've only got 20 minutes or so and we're going to get straight into having a chat with today's guest, Lisa Inge. Lisa, how are you going?
I'm great, thanks Phil.
Thanks for coming in.
You're very welcome.
Now, our guests might remember Lisa. She was in a couple of weeks, a month or so ago, I think, Viv.
Yep.
We're having a chat about property management. So Lisa runs a property management business called Let's Rent. And unlike a lot of real estate agents that sell properties and also look after property management, Lisa only is a property manager. She 100% focuses on helping investors lease their properties out and making sure that they have a good experience as a result of it. And I imagine a lot of that is drawn from you being a property investor yourself. So Lisa's come back to have a chat about her portfolio and what she's done and how she does it. And I imagine you probably have pretty good tenancy management as a part of it.
Well, as I said to you once before, Phil, I don't manage my properties. My team do. And I think that's really important because that creates a separation between myself and my tenants, which allows them to negotiate rent increases without sort of an emotional factor coming in, which I have certainly experienced in the past.
A property manager actually uses a property management person to manage their own properties. And I think that's a really good point.
Definitely.
For our listeners that as an investor myself, having a firewall between yourself and the property is it's a very powerful and strong thing because it allows you to not get connected emotionally and get sucked in that way, but also, and this is a theme that we always talk about on the Smart Property Investment Show, investing in property is like running a business.
It absolutely is. And the fact is that you need that barrier between yourself and the tenant, not just for yourself, but the tenant reacts quite differently to another party compared to the owner of the property.
Yeah, Lisa, I have been contacted by investors in the past who've managed their own properties. They've become really good friends with their tenants, which at first they think is fantastic because I can tell them anything, we can work together. But then when it comes time for a rent increase, it's like your mate asking you for money and they feel like they can say no.
Correct.
And then the process sort of gets derailed because of the friendship.
Yeah, and it doesn't even have to be a friendship. I have a client who lives in the same building as her tenants, and we had a scenario a couple of years ago where the tenant cornered her and negotiated a rent reduction. And then rang me and I went, you are not to have those conversations.
In the hallway.
So it's taken me 2 years to get the rent back up to the level that it was at prior to this negotiation.
Wow.
So she does never talk to her tenants anymore, apart from saying hello in the corridor.
Yeah.
But it's key in ensuring that you can manage it as a business.
I'm going to jump back to where we finished our conversation when we last caught up.
Yeah.
Just on that point, so don't be friends with your tenants is pretty much...
Correct.
So if your tenant, as an investor, if your tenant tries to engage you...
It's a business.
Try and say, always put it back to the property manager. Always put it back to the property manager.
Because if you don't, then it does, sometimes people's emotions do get in there and the tenant might say, look, we just can't afford a rent increase. They just bought a new car, but they can't afford a rent, which actually was what happened in that particular scenario I mentioned. So it's about perception. And the more that you create that professional barrier, the easier it is for you to negotiate rent increases, because when you're running it as a business, well, these are the market comparables. This is what your rent is now. We feel that the rent is probably $30 below market right now, so that's the increase we'll be putting through.
It's good advice.
It's not a negotiation. It may be, but it depends on the scenario. So sometimes we might push it a little bit further to actually achieve what we want in the end.
So, Lisa, we could talk about property management all day, but we did talk about it last time. So just to get to your portfolio and your investing, we often like to ask investors why they invest. So what is it about property and sort of what are you trying to achieve with your investments?
Oh, definitely wealth building, without a doubt. I know a lot about property because of what I do. My knowledge of what rents well is fairly good, I would say, based on what I do every day. And I think for me, I used to work in the stock market.
Okay.
and in banking and futures and so on. So I was very much exposed to the ups and downs of that particular marketplace in the late 80s. So my feeling and my preference is to invest in property, even though it may not be as liquid. It does not go through as much adjustment as perhaps
a bit less volatile.
Yeah.
And it should go up as well.
It should always go up. But it doesn't. I mean, realistically, we know it doesn't always go up, and we just have to factor that into our investments.
Yeah. And I guess that comes down to property it's quite simple, property investment, but property will go up in value if you buy the right property at the right time in the right place.
I completely agree with you.
So let's talk about the places that you've invested in property. How many properties in your portfolio now?
3.
3 properties. And when did you start investing?
About 5 years ago.
Okay. So relatively late to investing, would you say? I think I was relatively late to investing. So I wish I started investing a lot earlier than what I did.
Yes, and I would say the same thing. And if you don't mind me saying something personal, so I divorced at that time.
Okay.
So that enabled me to have much more flexibility about what I did with my cash.
Okay, so there was a catalyst,
yes,
or a watershed moment in your life that changed the way in which you decided to go about the business of wealth creation.
Yes.
So at that point, you, with a background in property, you went, well, I'm actually going to go out and start investing in property. So that was 5 years ago. So where did you buy first? What was your first property?
I bought a 3-bedroom, 2-bathroom, 1-car space apartment in Balmain.
Okay. I imagine you've done pretty well out of that.
Yes. Both on the value side and also the rent.
Side, yeah.
The rent's gone up about $100 over that time period, which is quite good if you compare it to, what the average would be in the marketplace.
So it's 3-bedroom, 2-bath, 3-bedroom, 1-bath. 3-bedroom, 2-bath.
3-bedroom, 2-bathroom, 1-car.
Apartment. So there's probably not that many like that in Balmain.
Correct.
Yeah. So talk to me about that. So that's looking at Balmain, and I know Balmain. I lived there when I was in my late 20s, early 30s, as a lot of people do. It's good pubs there.
That's why we moved there.
So most properties in Balmain, I wouldn't know the actual splits, and you probably know between apartment versus houses. There are more houses than apartments in Balmain. There would be in most pockets, I think. But it's quite a unique property having 3 bedrooms, 2 bathrooms as an apartment in Balmain.
Correct.
So what sort of tenants have you traditionally had in that property?
Well, I've only had 2 tenants over those 5 years. So the first tenants were a group of 3 people, and they were siblings.
Okay, interesting. And then the second set were?
A couple.
Okay, interesting. So you purchased that property. Why did you choose to buy that?
Because I thought it would be a good rental. Obviously, the number of bedrooms a property has to some extent dictates the rent. I knew that there weren't many 3-bedroom apartments in Balmain, so it sat between the sort of house and apartment market, and the market was a bit flat at that point in time, so I was able to negotiate a good price.
What did you pay for it?
$770.
Okay. As your first investment, you pay $770, which is on the high side for a lot of first-time investors, but that's the nature of the market there. That's an average price in Balmain. So $770 5 years ago, what's it worth today?
I've just had it revalued at 1.1.
Okay, so you have done pretty well out of it. Yeah.
Yes.
And have you extracted any cash out of that to help underwrite additional investments? Has that been your process, or
I've just gone through that process.
Okay.
Yes.
So the second property that you purchased, whereabouts was that?
Glebe.
And what was that?
It's a 4-bedroom townhouse with 4 car spaces.
4 car spaces?
Yes.
That's got to be pretty unique in Glebe.
Is that just the backyard, is it?
There are 2 on title, and then there are 2 on 2 separate titles. So although it sounds like a great thing, it's probably actually a negative because the costs increase as a result of those extra 2 lots. Do I get more rent having 4 rather than 2 car spaces? I don't think so. But again, I negotiated it at a time when the property next door was also on the market.
Okay.
So I think I bought it for a good price, and I knew what the rental return would be on it.
So what did you pay for that property?
1.16.
Okay, and today it's
just been revalued at 1.5.
Okay, so another big tick for
yes.
capital growth.
So that's after 2.5 years, yeah.
Okay, good investment. And
I think so, yeah.
and why that location? What really attracted you? So Glebe is not that dissimilar from Balmain.
Yes, it is. In terms of demographic.
Yes.
Yes, yep. But it is still going through gentrification, whereas Balmain really has gone through that process.
Yeah.
So what you have in Glebe is you have access to a greater crossover of demographics. So you have families, you have people sharing, professionals, and you also have students sharing. So it's a bigger mix of people. So there are certain areas in Sydney that where you're pricing rentals based off the number of rooms rather than looking at
the whole thing.
Yeah, exactly. Yeah.
And do you have students in there?
No.
Okay.
This is my second lot of tenants, and it's a family of 6.
Okay. Yeah, they probably need that much space.
Yeah, they do. Pretty sure they do.
And the third property?
It's a one-bedder in Dulwich Hill, which is in my self-managed super fund.
Okay.
And I think I bought that 3 years ago.
What'd you pay for that property?
$480.
What sort of yield are you getting on it?
It's okay. I'm getting $490 a week. I just relet it.
The property that's in your self-managed super fund is very different to the properties that are outside of your self-managed super fund. Can you tell me a
I'm
little
sure
bit
you
about,
understand why.
I understand. Can you tell our listeners why there would be that difference?
Yeah, because you need a much higher deposit in your superannuation fund to facilitate a purchase. Honestly, I think it's about 30%. So you need to have significantly more cash available in your super fund to do that. So at the time, I wanted to buy another property, and the price was dictated by the amount of cash I had in my super fund.
So the two properties you have, one in Glebe and the other one in Balmain.
Yep.
Can you talk me through the process of identifying these properties, how you went about identifying the area? And I think you live in that area, so you've probably got a good feel for, you understand the markets there. But how did you go about locating these particular properties? And talk me through the process of, let's start with the Glebe one, about securing it. Was it private treaty? Was it auction? Can you give us that story?
I haven't ever bought a property at auction.
Okay.
So when I bought Balmain, it had not sold at auction, and it was just after that auction process. And in fact, I had been looking around but hadn't seen the property physically until this one Saturday, and I actually exchanged that afternoon.
So did you go to the auction?
No, I didn't.
So you knew the auction happened, it was passed in.
Correct, yeah.
And then
I thought it would sell for more.
Yeah.
And then when it came on the market, I think it was at $760 plus or something like that. Then I went and had a look at it because, at that point in time, I needed to have a really good idea of what it would sell for before I went and looked at it.
So do you know what the maximum bid was at auction on it?
I actually don't think it went to auction. I think that it was withdrawn from auction.
Okay.
So they did have a bid on it when I looked at it. And so then I just increased that by $5,000 and secured the property that afternoon.
So obviously the agent wanted to get rid of it pretty quickly. They knew that it had gone through a marketing process and it hadn't
Correct.
sold. So as an investor, you saw opportunity there. So
Yes.
if something goes through if you don't sell a property quickly and
The market drops off
on the
pretty-
market,
it'll drop
drops
off
pretty quickly.
Yeah, exactly.
So as an investor, you would recommend then trying to look at those properties. Something hasn't sold for a particular reason, and it hasn't sold for a particular reason. One of those could be, price. Something could be fundamentally wrong with the property. But those properties, and I know a lot of investors look at this stuff that's sat on the market for a long time and they can see a difference in it,
Sure.
or they've got the capability or clout to be able to go in there and negotiate quickly and secure it. So you viewed it on the Saturday morning and you signed a contract in the afternoon. Is that right?
That's right, yep.
And you did that with a sense of security, knowing that you had financing all set up and ready to go?
Yes.
Okay. So did you have a pre-approval in place when you went through that?
I did.
Okay. And your recommendations
And not
around-
only that, I knew what it should rent for, so I was comfortable with that return because I paid $770 and I got $800, and I was comfortable at that $800 price point when I purchased the property. I think that's a really important factor for investors, that you need to feel really comfortable about the sort of rent that you are going to achieve, and obviously you need to factor some fat into that as well. But make sure you do your market research on the rental side as well as the purchase side. It's not a one-sided equation.
And how would you recommend establishing, you're in the rental game, so you know it really well, and you have a massive advantage on pretty much everyone else, but what would your recommendation around if I'm looking to buy this property over here and I can jump on realestate.com.au and work out what other properties that are similar to that are getting rented at. That's one thing. But what else should someone do to try and help establish what the rental of that property would be?
If you already have a property manager, ask your current property manager to look at that property before you purchase it. Don't take the sales agent's rental valuation because they're often incorrect. Or establish a relationship with a local agent like myself. I love going out looking at property. I never get sick of it. So we always offer that service free to any potential client. If they want us to go and look at a property, give them a rental valuation, then we're very happy to do that in the interest of picking up that business. But there's no reason why you can't do that in any area. If you're, talk to local property managers. They are the ones who are renting properties out on a daily basis. Surely they have some valuable information for you about what rents well and where the sectors in that marketplace are particularly short on supply.
So, as an example, if I was looking to buy a place in your area, in Balmain, where you're office is, if I went and had a look around, I went, I like this property, I did some buildings, I'm confident that it's priced about right, etc., etc. If I called you up and said, hi, Lisa, or one of your BDMs, I'm looking at buying this property. Can you tell me how much it should be renting at? Is that a typical phone call you would get from people, or it's not?
I wouldn't
that
say
common?
it's a typical call I receive from current clients.
Okay.
And I've received those calls fairly regularly. The market is obviously very toppy on the sales side at the moment, so those calls have dropped off. And the reality is that when clients have been looking, say, in the last 6 months or so, the rental valuations I'm giving them don't really justify the purchase.
Lisa, you talked us through how you identified the properties that you bought outside of your self-managed super fund. Did that process differ when you were buying with your fund? Did you need to look for sort of different characteristics or look at different figures?
Definitely. When I purchased in the self-managed super fund, obviously there was a limitation on how much I could spend, and I was comfortable with the rent level that I was going to achieve on that property because it had already rented at that level, so that was key. It had to have some uniqueness. I don't see any point in investing in a property unless it has something about it that you can't look at, any day of the week in another property. So it's a warehouse conversion. I had to compromise in that price point as well. So the only negative with the property is that it doesn't have a balcony, which we know as investors is something to look out for. But it has rented very well, and it has rented due to that uniqueness. It's also about 60 square metres internally.
Okay. And without getting too personal, we'll stick more to sort of the numbers and the theory behind it. But you did mention that you started investing in property because you were sort of going through a divorce and had more control of your own finances. We do sort of have a number of women in Australia reaching a certain age, going through that process and sort of not having enough money to support themselves, or suddenly being in a situation where, they've got this financial freedom but they don't know what to do with it. What would your advice to those people be?
I love investing in property. Yes, it has been successful from my perspective. It gave me a lot of flexibility at the time. So what I did was I rented. I have 3 children, so I needed to have a property that was perhaps larger than what I could afford. Well, it was larger than what I could afford to purchase. So the fact that you can negatively gear and also use depreciation as a tax tool does enable you to invest quite well while you're renting yourself, and it gives you the opportunity to build wealth without purchasing a family home perhaps.
So would your advice maybe be, don't necessarily go out there and buy for yourself, maybe look if you can get a better deal by investing?
I would, yeah. I think it's a great way to build wealth.
And how do you go about sort of getting educated, you think, if you're a new investor? What steps or what tips would you say to help someone gain the confidence so they feel they can make the decisions they need to make in order to become an investor? What would those steps be?
I think it's quite hard for women, to be honest, because they often haven't been in control of the finances and they don't necessarily understand the mechanism of building wealth. So I think it's important to talk to advisors, not just one, of course. Talk to a number of different advisors and do the numbers yourself. It's important that you understand what cash flow you need when you purchase a property. So you need to educate yourself because ultimately you are the only person responsible for building your wealth. So you need to have those tools, including the knowledge of where the cash is, what sort of property you can purchase, and how much additional you may need in the bank to cover those unusual situations.
So if you can go back 5 years and speak to yourself before you embarked on this phase of investing, what would you tell yourself back then? Anything in particular, any mistakes you've made or something that you could have done that you shouldn't do? Is there any words of wisdom to the Lisa 5 years ago?
Buy more property.
So many people say that.
Look, I think, for me as a business owner as well, and I've been a business owner for 11 years, so cash flow was something I really understood. So having more confidence in that sphere could have helped, certainly. When I purchased the property in Glebe, I actually did that using my business as collateral.
Okay.
So it was a much more complex scenario, but it did enable me to purchase that property and it rents for $1,200 a week. So, the yield on it is actually quite good.
And are you currently looking for your next place?
Always.
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 So what's next then? What are you ready to buy now, or is it you find the right place?
I'm just
do it?
watching the market right now. I've obviously had my properties revalued recently to enable that to happen. So I'm prepared, but it's important that you don't go out into the marketplace and purchase the first property you see or the second property. So I really recommend that you start watching the market at least 6 months prior to your purchase so that you can get a feel for how properties are selling. So when I purchased Glebe, the fact that those 2 properties next door to each other were going for auction, I think, on the same day. Neither of them sold at auction, and I knew which one I had the preference for, so I negotiated straight away on that. So you need to have that market knowledge, and the only way to gain that is to get out there and go and see properties.
But you also need to be opportunistic as well.
Of course you do, but you won't know when those opportunities are going to arise unless you have the market info.
So on the basis of capitalising or being opportunistic, so you've had your properties revalued and there's been a substantial increase in their value, so that's equity that you can draw down on.
Yes.
Have you actually pulled the cash out of that now and you're sitting on cash, or it's something that you will do at a point in time when you've identified that?
I'll only do that when I need to.
Okay, good. I think that's it, Viv.
Yeah, I think that's it.
We're out of time.
We're going to be here all day otherwise,
Yeah.
just talking property management and property portfolios. And
Well, they are fascinating subjects.
They are great. Okay, well, next time, your next purchase, let us know and let's get you back in. You can talk us all through.
I will do.
Which will be really good. Thanks for coming, Lisa. Really enjoyed it.
Thanks for having me.
Viv, thanks again.
Thanks, Phil.
Another great podcast. Keep the reviews coming on iTunes, guys. It's not very often now they're outside of the top 10 podcasts on iTunes for business. So, which is quite satisfying to know that
It is.
my ramblings and Viv's ramblings, so you don't ramble, I ramble, are valued and you're getting a lot of insights from the guests that we bring in. So, on that basis, if you think you've got a good story, make sure you get in touch with us, editor@smartpropertyinvestment.com.au. We'd love to have you on the show. Otherwise, if you've got any stories or Q&As or stuff like that, you can contact us as well and we'll get it up on the website. Thanks for tuning in. Remember to check us out, smartpropertyinvestment.com.au. We're on all the social, Facebook, Twitter, LinkedIn, or you can follow me on Twitter @PhilipTarrant. We'll see you next week. Bye-bye.